Today's episode is brought to you by Stream by AlphaSense, an expert interview transcript library that integrates AI-generated call summaries and NLP search technology so their clients can quickly pinpoint the most critical insights. Start your free trial at www.streamrg.co/PMC. That's STREAMRG.co/PMC. This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap Podcast. I'm your host, Robert Kraft. Thank you all so much for the support and for tuning in. Be sure to subscribe to our recently launched Substack, the Planet MicroCap newsletter, for free at microcapnewsletter.substack.com. I'll be sharing all recent podcast episodes from Planet MicroCap and Due Diligence. Plus, every Sunday, I put out our weekly MicroCap wrap to show how the microcap space has performed each week and compared to the broader markets based on data from the MicroCap Review Index. So again, to subscribe, please go to microcapnewsletter.substack.com. Now, for this episode of the Planet MicroCap Podcast, I spoke with Carter Johnson, founder of MCJ Capital Partners. We were introduced by Adam Mead, recent guest on the show, whom he dubbed his microcap guy. So shout out to Adam and thank you. I've done a few interviews over the years with microcap management teams claiming that they're holding companies the next Berkshire or a mini-Berkshire, the goal being to build the next multi-billion-dollar conglomerate. I say this slightly in jest because I'm not sure how many of those companies are still around. However, it inspired my conversation with Carter today because he focuses on finding quality conglomerates, but also serial acquirers as a whole. So thank you again for tuning in to episode 235 of the Planet MicroCap Podcast, and please enjoy my conversation with Carter Johnson. This episode is brought to you by Stream by AlphaSense. You can find them at streamrg.co/PMC. That's STREAMRG.co/PMC. Stream is an expert interview transcript library that is starting to become an integral part to investors' research process. They have a number of interviews on a wide variety of companies, including TMT, consumers, industrials, real estate, and more. Stream provides over 300 expert interviews per week, and 70% of their experts are found exclusively on Stream. Stream is unlike any other transcript libraries. Stream integrates AI-generated call summaries and NLP search technology so their clients can quickly pinpoint the most critical insights. Stream's community of experts and thought leaders partner with Stream to build their professional brands and expand their industry influence. Right now, there are approximately 8,500 plus call transcripts available. For more information, please visit www.streamrg.co/PMC. That's STREAMRG.co/PMC. Welcome back, everyone, to the Planet MicroCap Podcast. I'm your host, Robert Kraft. You can follow me on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT. And joining me today is Carter Johnson. He is the founder of MCJ Capital Partners. Carter, thanks for joining me today. How you doing, man?
Hey, I'm doing great. Thanks for having me, Bobby.
It's great to have you on. So we were actually introduced by Adam Mead. When I had Adam on, we're MicroCap show. He's like, "Oh, let me get you my MicroCap guy," and he was talking about you. So I was really stoked that we were able to connect and get you on here. And I wanted to learn a little bit more about your investing philosophy and background and all that jazz.
Yeah. Well, thanks for having me. And Adam's a great guy. I always tease him he should come over to more of the microcap world. So I'm really glad to hear that he's doing a little bit more of that stuff. So good to hear.
Absolutely. I just heard a great like somebody who wasn't in microcaps, and they were trying to describe microcaps back to me using an analogy, and they were like, is investing in microcaps kind of like having a seat at the chef's table? And I was like, Yeah, like that's, so it's interesting when some other pros and like quality investors you don't know don't have any kind of exposure to microcaps just yet, because it's almost like they're not eating at the chef's table where all these other greats are at.
Oh, it's funny you say that, because it's always like baffled me why in higher education, finance is taught, and they'll use these like case studies of these huge, elaborate, complex businesses. And I'm like, man, the financial acronym would just, I feel like, skyrocket if you broke it down and used like microcaps or smaller companies just to explain concepts and walk through financial statements and go over capital structures and things like that. Because you get such a better view of those like fundamentals and the ingredients to tease out that chef analogy even more.
And across the board, you're not just your, this is what a good balance sheet looks like. It's like, it's important to also understand, like, what does a shit balance sheet look like?
Yeah, that's a great point. Yeah. So it's fun looking at companies smaller in size, for sure.
100%. So let's get your background, man. Where did your passion for investing begin?
Yeah. I think, I guess I can kind of walk you through the traditional side of it, and then the non-traditional. Like a lot of folks in this business, I for whatever reason, I stumbled across it at an early age, just had a genuine passion in markets and finance and business. So I was one of those guys who was, investing in companies at a pretty young age, and just following companies, not really knowing anything in terms of what I was doing, but just had that genuine interest and curiosity. Which, looking back, it's a little odd because no one in my family can tell you the difference between a stock or a bond. So I was just that weird kid on the beach, like reading Forbes and whatever book I stumbled across in Barnes and Nobles. But yeah, went to school to study finance. From there, that's where I guess my background takes a little bit of a non-traditional turn. I started a company with a buddy of mine when I was in school, and did that for a few years after we graduated, and we eventually sold it. But that was really where I cut my teeth on business. That was where I got a feel for, what's behind the numbers, so to speak, which was a great experience for me personally, because it really gave a lot of life and meaning to things like working capital and realizing, like, depreciation is a real expense. Like when a truck breaks down, that's you're seeing depreciation.
What was the business?
Yeah, so it was a moving company. We operated in the tri-state area of Kentucky, Indiana, Ohio. So, just like a blue collar business it was a great experience. Like it was. I wish you were still around.
I need one right now.
What's that?
I need one right now. We're about to move in a couple of weeks.
Yeah, you're out in Utah, right? I don't think they're.
No, I'm in LA. So
LA, right.
Yeah. so you got a truck out here, man. Let me know. Yeah. Give me a deal.
Yeah. So, but anyways, after I sold that, I moved out to Colorado. I knew I wanted to get back more towards the investment side of things. And really, there was a couple of things I really wanted to accomplish after I sold the business. I really wanted to improve my accounting acronym and really just like sharpen that side of my game. And then I also really wanted to understand more of the valuation process and how that unfolds over different cycles and stuff. So I like to joke in my, late 20s and into my 30s, I had this like business walkabout where I had this like freedom to dive in and really just follow any curiosity I had in terms of like industry or business concepts, whatever it was there. And that was really fun. I did a lot of formal valuation work, a lot of forensic accounting stuff. Again, just kind of sharpening that acronym. And then let's see, around 2019, a buddy of mine who was a fund manager, he kept getting on me like, hey, when are you going to make a move and really formalize this that you're going after? So I put together MCJ Capital Partners and really, started Capital Hit accounts. It was like the first week in February of 2020, which was talk about great timing. That was kind of hilarious, but Capital came in and really just started MCJ Capital Partners for myself and a few family friends. And that's where I'm at now, just a small shop, having fun, analyzing small companies.
I was going to say, so how did you get to smaller companies?
Yeah, well, I think for me, it was a natural kind of transition. When you're looking at, so I did a lot of formal valuation work in private markets. And when you're looking at, valuations in private markets, if you're transitioning over to public equities and, you're looking at businesses that are a few $100 million in market cap, I mean, I feel like so many people come from the public side where they're looking at these huge businesses like your Apples or your Googles. And then they look at small companies and they're like, whoa, I wouldn't touch that. Like it's so small. If you come from the private world, it's like you're looking at these companies and you're really comfortable with the size and the challenges and kind of where they are in their own story, so to speak. So for me, I was looking at a lot of private companies actually making a run to potentially acquire a private company and go more of a holding company structure. But I kept looking at deals and I would find stuff that was better, that was, listed on the OTC or just smaller companies out there. And then I just kept seeing these opportunity sets and I was like, man, to me, it makes a lot more sense to go after these good companies that already have listed securities in some sort or another. It made a lot of sense to me. So yeah, that's kind of how I stumbled into the microcap world, if you will.
Absolutely. So, I mean, all right, you got to take me back to that time. I mean, did you already have capital committed before Feb 2020, or were you actively marketing? Like, because that's wild, man. Like, basically starting your fund, at that time. Which, hey, in hindsight, I'm not being that bad at timing.
Yeah, it wasn't. It was
performance-wise, at least.
Yeah, it was more like, okay, hey, I'm going to do this. I'm going to create the solution that I want in terms of how I want my capital, my family's capital invested. And then if I find other investors, great. If not, so be it. I'm still creating the solution that I want as a wealth creation vehicle going forth. And then I had a few friends and family who were always asking me like, hey, what are you working on? I'd like to invest. So that part was a little bit easier. And again, I had a buddy who was a fund manager who was, he was, first capital outside of my own. And it was one of those where my wife was on board as well. And it wasn't like I was looking to launch something of a certain size with a certain amount of overhead. So I had to go out and fundraise. It was very much just like, hey, I'm creating a lean solution vehicle for how I wanted my own capital invested. So
I'd like to take a quick second to tell you about this episode's sponsor, Quarter. With Quarter, you get frictionless access to conference calls, investor presentations, transcripts, and earnings reports from markets all around the world, straight from your pocket for no cost. Quarter's mission is to change the way people look at investor relations and create a completely new bridge between companies and stakeholders. The first step on this journey is to let you, the user, interact with the company's content while you're listening. Visit your app store of choice and try it out today by searching for Quarter. And that's Quartr. Now back to the show. All right, so let's talk philosophy, man. So, I mean, you kind of got into it a little bit there. And, obviously there's the bias towards a smaller, microcaps or just small cap and below?
Definitely favor small companies. Okay. Well, I do. So it's interesting, philosophy style, however you want to kind of talk about that. I wouldn't classify myself as like a hardcore growth guy or a hardcore value guy. Like if you look at our portfolio, we have stuff that meets both perimeters, something that you would find with a growth oriented portfolio and something you would find with like a true value oriented portfolio. So I don't really classify myself in one of those buckets. At the end of the day, I just really like good companies. And I definitely favor smaller companies, so small microcap, things of that nature. That's my preference. I think there's a lot of components and dynamics of investing in small companies that really can set up long runs for success, especially if you get in the right type of model, one that has the components to really just compound internally. Obviously, everybody's looking for something like that, but then you have all these, obvious constraints that come into play. Where if you're fishing in these small ponds for smaller companies, And if you're willing to go even international, so outside of the US, you really, you're not having to necessarily compete against the Buffetts, the Ackmans, the Icons, things of that nature. So just your opportunity sets, there's just a lot more stuff there, as well as just like lack of coverage from the sell side. So that's all. Those are like interesting dynamics. I read a book, I think it was Brian Bears who wrote it, Small Cap Advantage. I read that a few years ago, and to me, it just made so much sense what he articulated in that book. I don't know. Have you read that book at all by chance?
I haven't read that. I've heard of it, but I haven't read that one yet.
Oh,
I've seen Brian Bear speak though many times. And
he's such a smart guy. Yeah, super sharp. And what he lays out in that book, and I think he wrote it 10 plus years ago, but it still holds true today. And he explains a lot of those dynamics that come into play with small companies, and it's really it's just an interesting place to fish, and especially if you have, if you don't have the problem, I'll say that with air quotes, of managing $1 billion plus or something. It's a great place to look for ideal opportunity sets. So.
Let me go back to something that I brought up at the beginning. We were introduced by Adam. You're kind of this small micro cap guy. Mm-hmm. I mean, what in talking with folks that may not understand the opportunities of small micro caps, and listen, I'm not trying to be too fly the flag. Obviously, you gotta be. There's a lot of crap. There's okay, all the normal stuff.
Yeah, or keep going, but we can jump into that a little bit. Why? We'll keep going with what you're saying though.
Okay. All right. Well, I was just saying, like, when you were having those conversations with folks, like, hey, this is kind of the strategy, this is the bias that we're going towards, what's some of the pushback that you get? What are some of those frequently asked questions and like small micro caps? Like, why can't you just Yeah.
Well, it's interesting, especially depending on who you're having that conversation with. I find international investors, so folks I talk with over in Europe and Australia and stuff, they're a lot more like receptive to, oh yeah, small companies, market cap less than 100 million. It's not like you have to go over the merits of that one way or another. They just they don't skip a beat. They want to get right into the conversation about the company, what they do, the industry dynamics. Here in the States, I feel like a lot of times you bring up small micro cap companies and you get real like, whoa, that's that's kind of the wild, wild west. And rightfully so, right? Like there is a lot of junk out there in the small cap space. And I think that's what makes it so great. It's a deterrent to so many professional investors. So there are just a ton of rocks to turn over. And there's not nearly as much institutional coverage and investment that's underwriting those companies. So for smaller capital bases, you can go in there, you can actually do the work of turning over those rocks and effectively making an efficient market in the sense by finding an opportunity set that others are missing. So it's a really interesting dynamic. The other thing I like about it, we live in this world where index funds are rightfully, all the rage. And yet if you look at micro caps and small caps, a lot of times the dimensions of like liquidity and whatnot, it prevents a lot of these companies from ever being eligible for these ETFs. And Brian Bears, he does a phenomenal job of explaining this component with ETFs, where you have this weird space with small cap ETFs where they're outlined based off of market cap size. And then you essentially have these good small companies that are growing, and then they'll graduate up out of that class. And that ETF that's supposed to be this passive vehicle, it essentially dumps that winner, right? But then simultaneously, you have these awful dying companies that were a large cap, now they're coming through mid cap level, and now they're in the small cap level. And then the ETF is now including those in size because they're a dying business and coming in range there. So essentially with passive solutions with these smaller companies, you have them selling away the best companies and doubling down on these dying worst ones. And don't get me wrong, you can still do, passive type of investing not investment advice or anything, but there's a lot of advantages to go out and actively discovering these on your own versus doing just a passive index fund.
It's so interesting you say that, because we manage, we have our own index that we just launched earlier this year called the MicroCap Review Index, and we've just did our Q3 reconstitution. And I mean, well, listen, all microcaps got absolutely killed, but it's really interesting seeing some of the names that came through for Q3. A lot of fallen angels, a lot of names that I was like, oh wow, I still wouldn't have expected, despite almost everyone taking a haircut in the first half of 2022. So it's interesting that you say that, and then of course, you see your winner. You see your winners, the ones that are performing great, like, oh, they got to go, they're beyond 300 million.
Yeah. It's an interesting dynamic. That's what it is. And then kind of, I don't know if I'm changing the subject too much, but a big thing of what I focus on. So I really like small companies. I like them for the dynamics that we're talking about. And then I spend a lot of time on serial acquirers. So again, it's another area and kind of edge of the market where most investors just put their hands up and they're like, no, I'm not going to touch that stuff, and there's all these deterrents. And I think when you layer small cap companies and a serial acquirer component to it, man, there's a lot of fun stuff. There's a lot of, just crap as well, but a lot of fun stuff if you're willing to turn over the rocks and put in the work.
For sure. All right, let's dig in a little bit. You mentioned that you like kind of these serial acquirers. Tell us a little bit more about what that ideal investment looks like for you.
Yeah. So serial acquirers, they're really fascinating to me. It's actually, so I met Adam years ago at a Berkshire Hathaway meeting, and I promise I'll get full story on why I gravitate towards serial acquirers, but just to kind of give you a background, I've always found conglomerates to be a fascinating business model. I remember reading about them as a teenager and just thinking, wow, this is really interesting. This whole idea that you could have a business that encompasses multiple verticals and essentially smooth out results over an economic cycle. So I really found conglomerates interesting, and how I stumbled across Buffett and Berkshire was actually probably like a little bit inverse of what I think most people do. I studied first Berkshire because I was interested in it from a conglomerate perspective. And then I stumbled into Buffett and I was like, wow, this guy, he is, very impressive, and the humility and everything else. So with serial acquirers, it's if you think about your traditional company, a lot of times with your traditional company, you have it's pretty hard to consistently redeploy capital at high rates of return. It's one of those where there's only so much in terms of deploying capital organically that can be done in a way where you hold those returns and keep reinvesting in the business at a high rate. And what you usually see with traditional businesses is you have these opportunity sets. Management is looking to reinvest. They're looking to do things, but it's almost this race towards the bottom in terms of finding projects that have high rates of returns. So eventually, with your traditional business model, a lot of times you have to worry about either the business becoming obsolete or growth just fully maturing and running at GDP equivalent type of growth at best. If you look at serial acquirers, what's fascinating, and they're not all like this by any means, but serial acquirers usually have this structural component where they're saying, hey, we're going to dominate a niche market, and then we're going to take the capital that's spinning off of that and find these other niche markets to reinvest in and grow the business that way. And to me, that makes just a lot of intuitive sense. It's very much like investing at a portfolio level in a way. So I think you asked, what's ideal? What do I look for? I love to find a small company that has that structural and cultural dynamic that allows it to exist as a serial acquirer, and they're not doing these Hail Mary, make or break, all or nothing type of acquisitions. They're going out and systematically acquiring small little bolt-ons or businesses, of similar size to systematically keep growing the business year over year. And when you find those types of companies, those that are already small in size, so they don't necessarily yet have that institutional coverage, and then they're also doing some sort of serial acquire type of strategy, a lot of times there's very little coverage on those. They're a little bit harder to analyze, but they've got great opportunity sets for longer runways to just keep systematically redeploying capital and compounding those earnings over the long run. So that's a long-winded answer to your question, but that's a big reason why I look for those two dynamics of small companies and serial acquirers.
Gotcha. So, what would you say then for you is the big difference between a serial acquirer and, let's say, that classic roll-up strategy?
Yeah, so there are all sorts of serial acquire strategies and types. You have the platforms, you have the roll-ups, you have your traditional conglomerates, you have like more of a holding company type of structure. So, that's one of the big things that I do when I come across a new serial acquirer is really start dissecting what type of serial acquirer it is. You'll have bolt-ons that are specifically focused on just kind of doing your same type of business over and over. So they're really good at understanding industry dynamics and understanding where they can pick up market share and where they can really go out and make a dent in terms of acquisitions. And then you'll have other serial acquirers who have a strategy where they're acquiring across all sorts of verticals. And it's, there's different types of serial acquirers require different types of analysis and understanding of what's going on and what's unfolding. But that's what makes it really interesting and makes it a lot of fun. And it's a really cool model to dig into. And I find it, Bobby, it's very similar to, if you look at just like small microcap companies, there's a lot that are not worth the attention. They're just absolute junk. And there's a lot of that with acquirers out there too. They've kind of gotten a bad name in terms of Main Street like investment circles, just because a lot of them are destroying shareholder capital in the sense when they do these acquisitions. But then you have these other sets of serial acquirers who really get what they're doing. And they really understand what levers to pull and how to go out and deploy capital at those high rates of returns, and then build the systems and the culture that keeps that moving forth and pushing it down within the organization to where it's just kind of the rally cry throughout the organization.
For sure. Well, it's interesting because I think it also gets a bad rap because I do a ton of interviews with CEOs and, especially when I come across a conglomerate or, the roll-up strategy or something on the serial acquire side, when they say, oh yeah, we got a Berkshire model, it's going to be kind of like a Berkshire model. Right. Like, oh, sick. Okay.
Great. Everybody's
cool. Right. Yeah. Cool. Great. I'm sure, good luck.
It's fascinating there. Just because you're doing acquisitions, I don't think it puts you anywhere near a Berkshire type of model by any means. But I think you see components of management who have studied Berkshire and they're trying to implement it, or they figured out,
which we appreciate.
Right. Or maybe they figured out something that took Berkshire and Buffett years to figure out, and they're building off of that.
I say that not to poo-poo the ones that are trying, because it's good to have big lofty goals. I appreciate that, but more often than not,
and that's why there's, I think, such a great opportunity set in there, because it is being able to dig through and sort through and figure out which ones are and which ones aren't. And it's fascinating. And I've gravitated towards that type of model. So for me, it's fun, not just to study like a Berkshire, but I'm a huge fan of Henry Singleton and Teledyne, and understanding like the back end systems that allowed him to go out and do 187 acquisitions, I think it was, by the end of his career, and how, that worked in his model, but it wouldn't necessarily work for a Berkshire or, a Constellation Software or something like that. So, it's fun dissecting them and figuring out, who's doing what way. Just all that in.
Full disclosure, I have to ask, are you a shareholder in Berkshire or Constellation?
Yes. Thanks for bringing that up. Yes. So Constellation, yes. Berkshire, a little bit in a personal account, and then no Teledyne. So even though Henry Singleton isn't there anymore, that's a little good business. So
no worries. Hey, and look, I want to get into some anecdotal experience, like for you, and this isn't, to hear to pitch your favorite idea or anything like that, but maybe using something that's in the portfolio or not, that gives like that perfect example for you, what that ideal serial acquirer looks like.
Yeah. Well, they're all different. I can give you one that's kind of, it'll be relevant to your audience and stuff because it's a microcap. And then, full disclosure, we own it, and accounts I manage. We own it there as well. Creighton's out of the UK. It's a company that I absolutely love. And hopefully eventually I'm warming Adam Mead up onto it. But Creighton's, they're in the toiletries business. So they make a lot of like skin and care and beauty products and things of that nature. And if you look at Creighton's, it has everything I like to see in both a small company as well as a serial acquirer. And as we record this, they just reported their second half, which it wasn't a great reporting period because a lot of their input cost with what's going on with energy over in the UK, but I think it's a phenomenal business that has all those components you look for. So it's a platform of sorts, and it operates in the space that it's highly fragmented. There's all these toiletry and beauty products that are small in size as well. And so Creighton's is of this Goldilocks size where they're starting to have economies of scale kick in. They know what they're doing. They've got distribution cells built up, so they can go out and they can acquire these brands, bring them in-house, and really under their discretion, they can expand those product lines while also plugging them into their sales and distribution. And then all while doing that, it's a credit to their actual equity because they're going out and acquiring these things at a multiple that is significantly less than where they trade. So it's a pretty cool dynamic where it's a small company that has just great management. They're doing all the right things as a small company, can do, but then they also have this acquisition component. And what I like, and sorry, Bobby, I feel like I'm monopolizing the conversation here. So let me know if you want me to take a breath so you can chime in.
I'm interviewing you, man. That's the whole
point. Yeah. I get super excited when I talk about this stuff.
Go, man. It's all good.
Yeah. But yeah, it's one of those, when I'm looking at small companies, I love to go in. I love to take apart the business and understand everything from its, products and service lines, to its management, to what like new hires they're bringing on board and what, backgrounds those new hires have. And Creighton's is one of those fun ones where, following the company for a few years, being able to see them, invest in the actual infrastructure of the business and get capacity at a point where it made sense to then bring on acquisitions, and then to, start actually upping their talent and recruiting executives that had different levels of specialties in different markets that they wanted to expand to. And then seeing them, start doing more acquisitions, and then now actually having an individual whose focus is purely on acquisitions. So the executive team can, go back more towards management of the core company versus just deal sourcing. It's really cool just to see that evolution and that cycle of that business. And I think that's one of the fun parts of small companies is getting that front row seat to seeing how those things unfold.
Absolutely. So I want to ask another little story time, and I appreciate you giving that example with Creighton's there. But what would you say was an investing experience that changed your career the most? That really, maybe more specifically, set you on this path of like serial acquirers. This is what I want to look for.
Yeah, I mean, it would have to be Constellation Software. I don't know how it wouldn't. Constellation was one of those weird companies I stumbled across. I want to say like 10 years ago. And again, it was actually just studying conglomerates and just, I call it tracing the vein, just like looking at similar companies with similar type of models and coming across Constellation Software. That was, so studying Singleton and what he built at Teledyne, I really was fascinated by this model and this idea that you could keep basically the size of acquisitions low, which generally means that you're acquiring companies, at a lower multiple, at a lower valuation, so you get higher returns on capital. And the problem with that is, it makes sense if you have 10 businesses and all else equal, you go out, you acquire one, you've grown that footprint 10%, right? But if you go out and you're at 100 businesses and you acquire just one, you've only like moved the needle 1%. So what I'm getting at is I was fascinated by this model that Henry Singleton was able to implement, where he was systematically able to go out and keep acquiring small companies of a smaller size. And, that's usually the exception of the rule, as opposed to the norm. So looking at that and trying to understand it, and then coming across Constellation Software to actually see it in real time, and then to follow that over the years and see it unfold. Obviously Constellation is, it is the hallmark shining star of serial acquirers. I don't know if anyone will ever do it better than what Mark Leonard and his team have done there, but just watching that unfold and trying to understand the architecture behind their structure, to me, that's been a real eye-opener to what can happen if all those components are there.
Nice. That's a really good example. I've been wanting to get Constellations. I mean, it's probably impossible, but we'd love to do an interview with Mark at some point on
Oh man.
Yeah. It's probably that will never happen.
I think that's one of the, the mystique and being camera shy, if you
I know.
But
there's a few. There's him. There's Monsters Energy. We would love to do on compounders. Some of those that just don't do anything, but just like obviously expel at some point. That'd be cool.
I find too those stories like so fascinating. Like Mark Leonard, with what the business was originally capitalized at, this whole idea that he really just needed to create a liquidity event for his private equity backers and stuff like that. Like, to me, that's one of the things I enjoy, is learning about the history of the company and the industry that they're in, and really understanding why even, are there shares that are listed that we can acquire. And a lot of times it's some weird story like that, right? Like there's some liquidity event they needed that just happened to be at that point in time. So it's fun.
No, absolutely. So, we've talked about what some of the ideal investment looks like in serial acquirers. Some of your favorites that got you excited about it, that you like to study to see, to make sure that, maybe other potential investments have some of those qualities. Well, let's do the opposite. What would you say are some of those red flags that are immediately like, hell no, trash bin junk?
That's a great question. That's a great question. I would say, obviously you find more of those than the other types, the exception to the rule. One of the big things, that's just one thing I really don't like is the make or break acquisitions. So usually you see that in a business where they have a dying or a slow growth type of core business, and management has to figure out how to make the company grow or get it back on track, right? So you really have two things happening there. You're basically looking at a company that's betting on a successful pivot into a market they know nothing about. And then also you're having management bet on a skill set that they haven't really honed in. So they're looking to actually complete acquisition, and it's not something they're versed in or anything of that nature. And then on top of that, they're going after bigger companies that are going to cost a lot more, have a lot lower returns. So, that's, you wouldn't necessarily call them a serial acquirer at that point. You would just, they're looking to complete acquisition. That's kind of, if you're looking at companies and you see the words acquisitions, that's like one of the big red flags that I look for. The other thing, especially more of the serial acquirers. So these are companies that have gone out and they're completing successful acquisitions. One of the red flags I look at is kind of the empire building mentality. So you'll just see deals that don't make sense either from a valuation perspective or how they plan to integrate the company. I really, really favor businesses that operate with a decentralized model. So they're pushing that those responsibilities down to the business unit level, keeping that management in place that understands that those niche dynamics that made the business successful in general. So a lot of times, seeing acquisitions that are completed and there's no real strategy outside of empire building or getting some sort of credit bump on the actual valuation between the stock and the acquired company on those earnings. That's another red flag that I'm usually like not that interested in. And then I'd say this isn't necessarily a red flag for others, but for me, it has to be in a space that I can understand. There's a lot of businesses out there that I can't figure out what in the world they're doing. I don't really understand the industry dynamics. So it's very hard for me to understand the strategy that they're putting forth, even when it is a serial acquirer type of model. So I would say those are the bigger, like, surface level red flags that I look for. And I'm always trying to kill something fast so I can work on something else of value.
I hear you. So, how big is the universe of potential ideas are there available to you based on your criteria that gets thrown in the junk, and then, the things that are getting interesting? And then follow up to that is, what are some of the catalysts that you look for that then pique your interest to look a little bit further?
Yeah. So in the serial acquirer space, there's around 300 right now that I track actively. And just so we're clear, it's not that I'm exclusively focused on serial acquirers, just like not exclusively on small companies. Like, I want good companies. It's just a lot of times I find that I want smaller companies and serial acquirers, and then you overlap those. Yeah, that's sweet spot.
I got you.
So the serial acquirer space specifically, there's about 300 that I track. Most of those not interested in. Sometimes they'll be too big. Sometimes they're just, again, that wheelhouse of my understanding, I can't really wrap my mind around it. So, when you whittle those down, you get to a nice list of, I'd say about 50 that I'm really constantly following and whatnot. And then from there, there's a handful where they definitely have the components of what I look for, but the risk dynamics of where the business model is, it's not at kind of that sweet spot where I like to swing. So I think it will be potentially, 5-10 years. So I'll follow the company and I'll look for those inflection points that I usually look for within serial acquirers. But I really want something within the business model to develop more prior to taking a swing, just to hedge against that risk component. And obviously that's going to usually, you're giving up a little bit of return, but on that risk curve, I just like a little bit more certainty in what's unfolding in terms of their model.
Very good. So then, we're getting a little towards the end here today. So, for new investors that I know we're focused specifically on serial acquirers, but as you can probably imagine, that's what's going to be the title here. And it's really fascinating because, I've done a few episodes on, roll up strategies but nothing really even on some of the other ideas, on conglomerates and some of the others.
Yeah.
So for those that are new to looking at serial acquirers, what's some advice that you would give them?
Oh man. Well, I think the big thing is like study those case studies that are successful. One of the things I really admire about Mark Leonard is that internally, Constellation Software, they would adamantly study. They called them high performing conglomerates. I think HPC. I forget I think it was high performing conglomerates, but they would dissect these successful businesses that had acquisition models to really understand how they worked and what they could imitate at Constellation Software. So I think for investors who are curious in serial acquirers, there's two things. Study the successful ones, and then also study them in their early days when they are smaller companies. And there's a lot of serial acquirers that are smaller in size that you would consider small, even microcap, that you can look at, and they're easier to analyze than these giant conglomerates that have so many moving parts. You're just going to get turned around 3 times over before you really wrap your mind around what's going. So I think that would be my two recommendations there.
I love it, man. All right. Well, with that, where can our audience go and find more information about you, MCJ Capital Partners, as well as follow you on social media?
Yeah. Our website, it's a great spot, mcjcapitalpartners.com. You can sign up for our memo and quarterly updates, things of that nature. And then I am out there on the Twitter machine. So Carter Johnson 23, because first 22 were already taken, I guess. But
you're a Michael Jordan fan. I mean,
there you go. Yeah.
Or LeBron. I don't know.
Yeah. I just like studying grades. So it's a lot of fun.
It's cool. I guess 23 is like becoming the 10 in soccer. It's the best player wears 23 in basketball. It is.
Yeah. There you go.
Well, Carter, thank you so much for joining me today, man. This was so much fun. Congrats. Well, early congrats. It's going to go great. We were talking offline. You're expecting the birth of your upcoming child, your first, I think, right?
Yeah. My wife and I are expecting our first here soon. So I'm glad we got this interview in, and it was a ton of fun. It was a ton of fun. So
same. Yeah, absolutely, dude. Well, thanks again, and I look forward to the next one.
Yeah, thanks for having me, Bobby. Take care.
This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.